Okay, so far in all the videos for this Wildcatter tutorial, I have gone over how to explore, develop, and then produce oil and natural gas deposits. Once again, my name is Matthew Blazewitz, and I am demonstrating the simulation that I designed and programmed. In this video, I want to cover how to raise capital. So we started out with $100 million, and we spent 58 million so far to find this one producing field right now. But we have turned a profit over the past several turns. So we'll end this turn again and double check, make sure we are still turning a profit, which we are. We've had net income of 7.5 million, so that is pretty good. The simulation calculates all the typical statistics related to accounting and corporate finance. So right here, I'm right-clicking on the main interface map to bring up the menu. I'm going to click on Market Info. From here, we can see the economy. It's in a bull market. That means that GDP is probably growing between probably around 3%, but the simulation has some slight deviation in that to provide an element of randomness. The income tax rate, it's a tax holiday right now. It's at 18%. This is the global GDP number below the income tax rate. Below that is the oil and gas consumption as a percentage of GDP, and that number will grow as more gas-consuming products come to the market, like automobiles and such other things. So later on in the simulation, this number will grow to approximately 9%, and that's about the time the simulation ends. The current GDP growth rate is 1.06%, but that is going to pick up in the next. It is going to pick up because we're in a bull market. So that GDP growth rate will probably be higher the next couple of turns. There's a smoothing effect that kind of lags, causes a lag in the GDP growth rate that's intrinsic to the simulation's calculations. The weighted firm 500 index, that number is a artificial stock index of 500 of the biggest firms in the simulation world. And right there you can see it went up 4%. And that the weighted firm 500 index tracks GDP to some degree. So when the economy is doing well, the weighted firm 500 index normally goes up. When it's doing poorly, it goes down. And those things affect a lot of things in the simulation, both the GDP and the weighted firm 500 index. They affect firstly they affect oil and gas prices because they affect demand. The other thing that affects oil and gas prices is the supply. And there are a lot of factors in the simulation that go into manipulating demand and supply totals to come up with the actual oil and gas price. The other thing the weighted firm 500 index, other purpose it serves is for beta calculation. The firm's beta is calculated tracking and using this index for its calculations. So beta representing the non-diversifiable risk in this simulation world. It's an important factor because the simulation uses the capital asset pricing model to calculate the cost of equity, and the cost of equity goes into the weighted average cost of capital, and all these numbers are displayed here on this little dialog box. The cost of debt is determined by a z-score of different liquidity ratios. We can see here that the z-score is 2.6, and that is a very good z-score. Typically between anything below 1 is really bad, and between 1 and 2 is kind of iffy. And between 1 and 2, you can expect higher cost of debt, and then below 1, really high cost of debt. And that represents investors' belief in the risk that your firm will default. So right now, because we have had some good quarters, we have a low cost of debt and a relatively low cost of equity for such a small firm. I mean, we have only $50 million in cash holdings right now. And that makes for a low weighted average cost of capital. Variance and covariance go into the beta calculation. And then below that, we also can see the estimated IPO price. So now that I've gone over that screen, I'm going to go over and right-click on the main simulation interface and click on Raise Capital. Here we can see on the right-hand side the capital structure, an all-equity company right now. On the left-hand side, you can select bond issue or stock offering, depending on what you wish to, which method you wish to raise capital. So right now, if I set the duration of the bond to 5 years or 6 years, and I'm going to increase the quality of, or the quantity of bonds. Okay, so our coupon rate right now is currently, investors are willing to pay 9% for our they're willing to pay 9% for our bonds. On each bond, so I have 2,000 bonds that I'm issuing, and the inflow from that issuing 2,000 bonds is going to be 20 million. And you can also see over here on the right-hand side that the capital structure changes dynamically as I set this up. But it doesn't issue the bonds until I actually hit the issue bond button. So I'm going to issue these bonds and receive this cash inflow. So right there on the top on the title bar, whereas we previously had 50 million, now we have 70 million. And I'm also going to issue some stock. This is going to be our IPO because we haven't issued any stock yet. So currently the market's receptive, and our inflow from our stock issue is going to be 58 million. And the way that the simulation prices a firm, it divides a smoothed net income value that incorporates net income from the past 5 years, and divides that by the weighted average cost of capital minus the growth rate, and that gives the firm the approximate value of the market value of the equity. So right here I'm going to hit issue stock, and now we have issued stock. So at the end of this term in our cash flow statement, we will see these activities that we just executed in the financing section of the cash flow statement. So let's take a look at that. Okay, we got our messages from our project managers telling us about what they've produced. Very well. And we wanted to look at our statement of cash flow. So we can see now we have the new debt, 20 million, and cash flow from equity issues. All those changed our cash, and we're representing a cash inflow. Also on the balance sheet now we have the long-term liabilities of 20 million. Once the payoff time once the maturity date approaches, once it gets within 1 year, those liabilities move up into the current liabilities section of the balance sheet. That's all done automatically by the simulation. Okay, that's it for this video. In the next video, I'm going to go over what charts are available in the simulation.